Excellent. Okay, well, welcome everybody to this webinar hosted by FX Street. My name is Sareed Harper. We've been doing these webinars for many years now, actually, and the concept is the same. We've just been doing a lot of the same over and over again, and we're just going to continue walking down that path. And so what we focus on is, it's pretty simple. It's supply and demand trading, and the way we trade supply and demand is also quite simple. So we're just looking for areas on a price chart where there is likely to see reaction at some stage in the future, and you can do this using various techniques. Being a software engineer, I like to turn everything into a computer problem, and that's fine. But you don't even need to do that. One of the really good ways of doing it is just using common sense and maybe spending a bit of time in front of the computer looking at charts. And I think doing this will, over time, give you tremendous insight as to what it is that we're supposed to be looking at. So today we're going to talk about how to identify areas of value, because this is essentially this is where people are looking to transact. And so you have traditional value, and then you have value that is maybe in the upper end, so a little bit expensive, like a premium value, and then you have discount value. And so, I mean, there are many different ways to identify a value using whatever tools that you may have in your arsenal, but I like to do it in a super simple way. And I have this technique that I started using quite a while ago. It's super simple, and I call it boxing. And the reason I call it boxing is because we use boxes when we use it. And so if you consider this price structure just here, this is the pound Kiwi. And so what you want to do is you want to look for the latest, the most recent big move. And we'll use more bleeding edge price here. And we'll do the analysis on the 4-hour chart. Okay, and you can see here what we've got. Let's use this swing here from here to here, okay, because this is a nice strong move. When price came up here, we managed to remove this area of micro supply, and I know it's supply because we had a reaction there. And then price, we came up to it, we failed, we built up some strength, some demand, and this is where price managed to move above this area of supply and trade above it. Okay, and so I'm just looking in the chat. Can't you see my screen, Ramon? I think everyone should see my screen. I'm sharing it at least. Adinda, can you see my screen? Yes. Okay, so it's being recorded, so you should be able to see it. Okay, and so if we focus on this swing here, we have a nice strong move from this low to this high. And this is an important swing because, I mean, when price moves away from a price point, like you can see here, there's a reason that's happening. Okay, so there's a very keen interest on buying down here. And if we have a look on the bigger time frame, you can see that here it is. This is that low. And what we're seeing is essentially we're seeing price revisit this low. Okay, so historically, this is an attractive price. We know this because price moved away from it. And so we are revisiting this attractive price down here once again. Okay, and so keeping that in mind, we focus on this price structure here. And so this is where the boxing comes in. So if I can use these drawing tools. Okay, so what I like to do is I like to draw a box. That wasn't very good. From the low to the high of this swing, and the swing, it goes up to here. Okay, so you go from here to here. Oh, this is dreadful. Okay, so that is one side of the box. And then we have to draw a box on the other side, which goes from here back down to the origin of this. And then when you have this, you see we have two sides. Let's my drawing. Okay, so this is what I refer to as the buy side. I use B, and this is what I refer to as a sell side, an S. Okay, so what this is it enables us to focus on supply and demand and not reactions to supply and demand. Okay, and so price moved from here up to here. Okay, so that means that there is buying. Oops, I mean there is buying from here all the way up here. There's no selling. There's not no selling here. The only selling that there wouldn't be any selling in this price structure. The selling would be done on reference points on this price structure over here. Okay, but if we focus on this one here, price went higher, and now it's moving lower. Okay, but once price finally turns around, like it did here when it finally started to break down, price started to have these small reactions to these reference points on the buy side of this chart. Okay, so we have the buy side, we have the sell side. Okay, so what we have when you have a strong move like this is a cheap price, this is a high price. Okay, and so if you wanted to make people happy, you know, try and keep the average price visible. I mean, the average price is here. Okay, so from this low to this high, if you add them together, divide by 2, you'll get this price window here. So this is the median price for this price structure here. Okay, and so you know that if price moves away from this high, comes down to this line, the median line, then you know that that's a pretty good price relative to these high prices and relative to these low prices here. This is kind of the halfway point. So we gave back 50% of that move. Okay, and so knowing that we have the buy side here, which means that you're only allowed to buy on price structures on this side of the chart, and here you're only allowed to sell on price structures formed on this side of the chart. That means that you're allowed to look here and find price sensitive areas on the buy side. Okay, but you don't want to buy here. You don't want to buy here once price comes back down to here. You want to make sure that you're buying at a reasonable price. And a reasonable price is going to be from here and lower. Okay, this is a really good price. Right here, this is a really good price. This is a pretty expensive price. Anything below this is a reasonable price. Okay, and so it's time to look for patterns when you've done that. Knowing that, you get rid of some of these lines. Knowing that, then you want to start to look for these traditional supply and demand platforms that we've seen. And if you watched some of the historical videos that we've done, we have this term called a slingshot. I think I went over the slingshot last time, actually. And a slingshot is essentially a price structure where price rallies, we pull back or we stabilize, we dart away, we pull back, we have a pullback, and then we release. Just making sure everyone... Hey, Sunil. Good to see you in there. Okay, and this is the slingshot. What does that mean? That means that price was able to move to these very high prices from the low of this candle here, because this is where the slingshot was pulled back to, and then it went higher. Okay, and this lines up beautifully with the 50% point of this box, so halfway down the box. Okay, this is a reasonable price, and so it's reasonable to think that should price revisit this price structure in the buy zone on this side of the chart in the future, it's reasonable to believe that this would entice people to begin to buy, because this was too expensive to buy. Price is not down here. This is really cheap. It's unlikely that it's going to come there here and now, but this is a reasonable price. Okay, and so you can expect prices to bounce and respect this level here in the future. Okay, so we had one visit, we had two visits, and each time price comes, it goes a little bit deeper. We had three visits. Okay, so the first visit lined up beautifully with the bottom of this buy zone. these. Okay, so it lined up beautifully with it. The next one went to it again, but the next one went a little bit lower. And this is often the case because if you consider for a moment this area of demand here that's formed, here's a slingshot, you can consider this to be like a plate of pancakes. I like to use this analogy a lot. Okay, and so if price is a fork and price comes down and pokes into this plate of pancakes, the first time price comes back to this plate of pancakes, it's going to remove the pancake on the top of the plate, okay? And the second time, it's going to have to go a little bit lower. And the third time, it's going to have to go a little bit lower. And so each time, the first visit, pancake's gone. Second visit, we kind of stayed close. Third visit, we went down to this pancake. And so now the next one, I mean, price is going to have to come a little bit deeper. Sorry. Okay, a little bit deeper. And this pancake analogy is essentially liquidity. Okay, so you have, if you look at this price structure here, okay, this is a reasonable price. You can expect selling to increase as we move higher and buying to increase as we move lower. Okay. And so this represents order blocks located on the buy side just here. Okay, so if price comes down and fills an order here, I mean, then this order here is gone. Okay, so there's nothing to do there. So price will have to come deeper to find the next one. And once that's gone, price will have to come deeper. And the reason this happens is because, I mean, there are orders nested in around here. If you look at an order book, it looks kind of like this. Okay, where you have the bottom of the book is like really thick, lots of orders, and it thins out a little bit. And maybe there are even gaps. There's nothing here. Okay, no one wants to buy here. And then it changes, and then we start to have sells, maybe thin liquidity, and it picks up, then we have selling up here like that. Okay, so you can see that this lines up with this little piece, this price structure here, the order book liquidity just here. Okay, but once price comes down and kind of feeds into this one here, then this is gone. That's gone. So next time, price will have to move down and pick up this one. And once that's been filled, then liquidity there is no longer available. It's gone. And so price will have to continue to move lower to this one. And once it's done that, then this is gone. Okay, and if the whole price point, if the whole thing is gone, like happened when price went down here, then price will typically have to move lower to the next reference point, which could be a more significant swing. Maybe this is a small, like a micro swing on the 4-hour chart, but if you look at the daily chart, maybe this is just, maybe this corresponds to this. Okay, and so this was attractive here, but now because price has started to move back into it, maybe price has to go lower and visit the reference points here on this leg. Okay, and so what boxing does is it enables you to sit on your hands, number one. Why? Because you know that you're not buying here when price is correcting. You know that you're always going to reference price structures on the buy side of the market. And if you want to sell, you'll be doing that on this side. You won't be selling at anything here. Okay, that would be incorrect. Okay? Does that make sense? And so if we take this example, we do one more. I delete all objects. Come on, bugger off. Such a pain. I turn this silly thing on. Okay, good. Good. And so if we use another tool, which we all know, I like to use a Fibonacci tool. And I don't use Fibonacci tool because of the Actually, this is a new platform, so these are all wrong. I'm just going to remove all of these. Buy, 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 buy. What I want in here is I want 50%. That's my 5. And I want 60%. It's my 6, 7, 70%, 80%. One more. 9 and 9. So what this does, it enables me to look right, does it? 6, 7, 8. Okay, so what it enables me to do is you attach this tool to the swing and you do not do anything until price moves beyond the 50%. So you're not fiddling around here, you're not doing anything here, you're waiting until price comes at least here, which it did here. Okay, you're not doing anything here, you're waiting for price to correct. Because what price is doing now, it's advertising cheaper prices in an attempt to bring people off on the sidelines back in. Okay, yeah, and so as you can see here pretty clearly, price first of all was here, then it went here a little bit deeper, then it went a little bit deeper here, then it went a little bit deeper here, it went a little bit, and you can see it tested it, went a little bit deeper, so it went down to 6. This is a 60% level, so this is starting to resemble like a premium, like a really good price, like a premium price. So not a premium, a discount price. Then price goes down. Okay, so now we're starting to creep lower, and price actually goes all the way down to here. Okay, so it goes in the bottom 20% of the box. Oh, sorry, of this swing, which is a really good price considering the fact that this was a reasonable price. Okay, so this is a really good price. Reasonable price, great price, really good price. Okay, that makes sense. Let's zoom out a little and let's just follow that along. So price went here. Okay, then you maybe some are asking like, well, okay, what about now? Price is here. What do we do now? Well, now, and you can do the same thing. So you take the most recent active swing. Let's move forward one at a time. Let's go here. I'll zoom in. Okay, price turned around on this bar here. Okay, this is a really cheap price just here. This is a really expensive price. This is reasonable. Price reacts. We sat on it, we go through that, and we go to like really cheap prices. And this is actually where the imbalance in supply and demand flipped to the advantage of the demand from the buyers, which caused price to rise once again. And we get another move from here to here. Okay, 50%. We sat on there, nice. We went through the 60, 70, almost to the 80%. Okay, and now price lagged. Where did it go? Well, it went to here. We don't know if this is a top yet because price has not turned around. You want price to do something like that. You want price to move towards the 50% from a high. Once it does that, then you're in good shape. Then it's time to start to begin to look to buy. And if you look at some patterns here, and we have just in here. So we have this little price nodule here. Okay, so we had a historically respected price here, and now it's removed. So I haven't used this platform before, so everything is wrong. Okay, so now this one's gone. The one that removed it is this, and now this one is gone. Which one removed it? This one did. This one here removed it. So this is the one we would look at in the future. And where is this located? This is actually located in the cheap end of this price structure. What does that mean? Well, that means that when price comes down to about the 60, which is where the slingshot is, slingshot, pulled back, and then snapped higher. How do you know this is important? Because we moved above this high. So that tells us we have strength in this move. And the strength comes from the 6. And so I wouldn't be looking to buy here. I would be looking to buy at least from this price point just here. Okay, so I would be keen, I'd be excited, and I'd be grateful to be able to pay this price, 191.36, around there, for the pound Kiwi dollar, until price does something similar to what it's been doing historically, here, here, and here. Okay, and so going back to the boxing thing, I mean, you could use fibs. You don't even have to use the boxing, but the boxing thing was just like a really nice way to visualize where these price zones are located. Okay, and it also forces you to stay out of the market when price is doing something like this. There's no reason to sell now. Okay, there's no reason to sell. There's not even reason to buy. So now there's nothing to do. Why? Because we want price to revisit this reasonable price. And once it revisits the reasonable price, then it's time to start to bargain hunt. And then this is when you focus on price structures like the slingshot. All right, let me see this. Okay, cool, Ramon, you're back in the warm. Good to hear. Welcome back. Okay, cool. Okay, good. Okay, let's do another example. Okay, let's do an example of where this can go wrong, like where you can get it wrong. Because obviously they're not all gonna work out. Well, first of all, what I like to do is to help keep things on my side, just to try and ensure that I'm making better decisions than poor decisions, is I want to find out what direction price is going. And I normally do this by waiting until price reacts at a price structure like this. So this box here was drawn on the chart when this green candle closed. So I knew that I was going to buy here when this green candle closed. Okay, so a lot of people are thinking, oh no, price left already, I missed that trade. No, you didn't. You didn't miss that at all. Price just has to come back to it, and it always does. This is a price inefficiency. If you go back to an order book example, there are going to be gaps in liquidity just here. So price, my neighbor just buzzing off there, has to come down to visit these. Okay, and so I knew that this would be a good place to buy. A situation like that, I mean, if you would have done this, and price came to the 50 here, didn't it? And then it kept going, and then it raced through the bottom. Okay, that didn't work out very well, did it? It didn't work out very well. But if you pay attention to the major swings from here, and then you zoom in on those swings in the smaller time frames, then you'll find that things normally work quite well. And just something that's super important to notice, when you have, this is actually a really important price structure just here. We have a low here, we have a high here, but notice how many times price came back on its way up to the high. Okay, what does that mean? Well, that tells us that the liquidity that was once, let me see if I can draw once more. Pencil. Okay, so the liquidity that was available, come on, pencil. The liquidity that was once down here, the liquidity was once down here, I mean, it's gone, and this is gone. And why is it gone? Because this kind of removes something in here, this removes something in here, this moved just beyond that, the pancake, the next pancake. And so you can expect price to go deeper next time. Okay, so you attach it to that, pay attention to where price has revisited. And if you pay attention to this, I mean, here we have a very clear buy zone. Okay, see, in price, came right down to the buy zone. This is the 80%. Okay. You move it to the low. This is a buy zone. Then you would be paying attention to this on the smaller time frames when you're looking at that. Okay. Because you can say, okay, we have a daily buy zone just here. We also have a daily buy zone here and here, but these were prior to this top being formed. Okay. And so this is a nice area of demand, tested. Now the top was formed. If you actually take this and just move it, if you move it with this, the top was formed. We came down to the 50% perfectly. We went beyond. We move it higher. We came down to the 60%. We went higher. We came down to the 50%. We came down to the 60%. And now we cut down and went all the way back down to the origin of this move here. Okay, so if we move this back to, let's do this, let's do a negative. It's not only buying, it's also selling. It's a price form this top, and it formed this bottom. That was a pretty strong move. It's strong because we know it's strong because we move through this area of demand that was tested once, twice, and now it's gone. Okay, it went down, not strong. So this is an important move. Price goes to the 50, we go to 60, and we turn around and we go all the way back down, almost to the other end. Okay, we poke into this area of demand. The software found this when this when this candle closed. Yeah, when this candle closed here. When this candle closed here, this box was drawn, and I knew that we would probably come back down to this price point here. Okay, so price went down to the 60, we came back down to there, so that gives you confidence in selling. If you sold here, you wouldn't expect price to go beyond this because of the box, and also because of the histogram here is showing us that we are very likely going to turn. So what this is showing me is just simply showing me the completion of cycles. So if you can see we have a bull cycle. Bull cycle started here. It ended here when we started to get these dots. We have one here, a minor one here. And we have the bear cycle begins and it slows down. We start to see these dots. When you have an increasing histogram and the dots, that's good news. That means we're likely going to turn. And we have bull cycle stops, and we have kind of sideways price movement. So these cycles will be more visible on the smaller time frames. Okay, and so seeing this combined with this, then we have a pretty good feeling that price is likely going to move above from here. Okay. Okay. Sorry. And so we visited the 60, 70, we touched the 80, which is a perfect sell zone right there. Area of supply, slingshot, departure. Okay, so now we're testing that. Okay, and now it's probably not a good idea to continue to sell because we have demand below price and we have supply being removed. So if you look at this one here, this area of supply was formed when this white candle closed. So we knew that we'd have reaction here. We had a likelihood of reaction there. Price kissed it, and we moved away. And then we removed this area of supply. We formed this demand. So that's telling us, oh, wow, it's probably not a good idea to begin to sell. And so keeping this in mind when you're on the smaller time frames like this one here, just keeps you on the right side of the trade, of the market rather, not the trade. Okay, we'll do one more example, and then we'll see if you guys have any questions. Okay, so it's here we have, let's use this swing because this is the most recent one that's complete. But we have complete as in we've had a move. So we came from here down to here. Okay, so you could argue that the origin of this move is here, not here, because price came down and then came back. So the origin is right here at this slingshot. So we went right here. Okay, So price came left here. We came down. We came up here, and we came right to the 50. Let's get okay, and then price came right up to here, and this is where we moved away from. Okay, so this is expensive price. This is a cheap price. This is a reasonable price at which to sell. And this is also a sell zone for this area of supply here. Okay, it was tested. The sell zone's right there. And this is where we left it. We moved away from. Okay, and now, what do we have? I'm moving down here. If you look at this, and we have these lows. Just here that tested this demand. Now it's gone. The origin of the move that removed it is right here. So we'll go to the 4 hour here, like so. We'll see. Okay, notice again here. Let's go from here. This is where it started right there. So this is maybe an untraditional way to draw fibs, but we're not drawing fibs for their ratios. We're drawing fibs for the zones. Okay, but notice here that price went here, went to the 50, and we came higher. Okay, what does that mean? That means that we're going to go at least to the 50 next time. Why? Because the pancakes are gone. So we'll probably go to the 70 and very likely the 80 because this is where the price structure occurred. Yeah, so we have something that looks like this. Just here. So this is probably where we're headed. Okay, so we already have a sell zone established super clearly right here. Micro sell zone, sell zone. I got a trade on, which one was it? I think it was, I can't remember. It was 2 days ago, and I wasn't in front of my computer to manage it. I couldn't manage it, and price revisited this. It almost got to the target, and then it turned around and stopped me out. And that's because I don't know. I was a little greedy, or I wasn't very mindful of the fact that we had the wicks so close. But pay attention to these because this is a micro slingshot, okay, which is the whole thing that we're talking about here. This is also a slingshot for this price structure just here. Okay, slingshot, slingshot. So price is going to come at least to that next time. Okay, super fascinating actually. And you can just do this all day long. And I recommend that you do this and you go back in time and you spend time. You could maybe go on a 15-minute chart. And you just go back and you have a look at these and how interesting and how powerful they are because they are relatively simple to trade. And we look at this one here as an example. We had from here to here. Okay, price came from here. We didn't quite get to the 50. We had another attempt, sell zone. This is where we got the reaction. This is where we came to it. We went to the 50, 60. We turned to the 70 because this is where we had the supply identified by the software. So price turned around. Did we react there again? No, where'd we go? We went to the 80. Okay, so this is how you play it. You don't overcomplicate it. You don't need more indicators on your chart. You just need to pay attention to these swings, keeping in mind the fact that price is moving lower. We are reacting on daily demand, but on the smaller time frame, it doesn't mean that you can't trade. It just means that you have to maybe manage the trades aggressively and just be a little bit careful. Okay. Okay, been rambling now for 36 minutes. I'm going to see if there are any questions. Do you guys have any questions, or do you want me to look at something specific? I know we can try and look at a crypto. I don't know if this broker has any crypto, or we can look at. let's have a look here. Let's have a look at this. Okay, so this is the daily chart. Okay, so this looks interesting right here. And what I would notice about this is that we had attempts to move beyond this level several times, but we failed. The origin of the move was this removal of this supply is here. We're getting close to that. Okay, so we could take this from here to here, and we are moving. Okay, if we did from here to here, well, let's do from here to here, because this is the origin of the move here. From here, okay, 50%, price sat on it. You can see it closed right on it. Then we cut through it, went 60, 70, 80. We started to see some reactions. 80, so the big reaction. Down a little bit deeper, so the buy zone is being tested now. Okay, this is the buy zone, we tested it, we turned, going a little bit deeper, so we're eager to find those other pancakes, the big pendings sitting there lurking, and looks like we're probably going to have another run down for here. If we come back down to this area here, and there's a very high likelihood the price is going to turn around and move higher. Where would you get out of this trade? You would look at this. Once it turns, let's assume that price stops right there. Where would you get out? Well, you would be sure to be careful once price came up here, because we have a pattern and we have a reasonable price for this price structure here. Expensive, cheap. This is reasonable, and this is super reasonable here. So we also have another pattern just here. Lines up nicely with that. So the 80, it's beautiful there. So we have two areas that we could watch buying here. Okay, these are two interesting areas that we will likely see a reaction. Okay, good. Any questions? No questions. Amazing. Everything is crystal clear. Does this stuff make sense? Does it seem complicated, or it's not complicated? If it's complicated, then you're doing something wrong. It's just really important to keep it super simple. We go here on the daily on the 1 hour chart on this price on this chart here. So where do we have a strong move? We had one here. Does that mean we trade here? No, it doesn't. Just means that we have a strong move. And here we didn't come back. We haven't turned around yet. Yeah, so we're still going lower until we've moved back up to here, to the midpoint or greater. Then we're still headed lower until price turns around, and this is where we kind of flip. Okay, and this is according to the order book, where you have bearish liquidity at the top of the book and bullish at the bottom of the book. Okay, and if price is able to move to the upper side of the book, which it will have done if once it moves past the 50% point, well, then that means that the bullish liquidity is heavier or thicker than the bearish liquidity, because it's able to gnaw away or consume the liquidity above price, if that makes sense. Cool. All right. Well, no questions. I hope this was interesting and useful. If you have any questions, if you watch this maybe and it still doesn't make sense, I'll send you my email. This is my email, and this is our website. We are a software company. We write software that does this stuff for us. If you have any questions, shoot me an email, and I'll be absolutely thrilled to help you with whatever I can. But I didn't. I think if everyone is happy, then I think we'll call it a night. It's 8:45 here in Bali. Adinda's in Jakarta. We're close, and I think you're about an hour behind me. So if anyone has any questions, but you don't think of them now, just shoot me an email. And that's it for tonight. Super, thank you so much. But thanks everybody for coming here today. I hope this was useful and interesting. I think it's always interesting talking about this kind of stuff. So yeah, until next time, thank you so much for being here today. Thank you, Epic Street, for having me once again. We'll speak to you all again soon next month. Thank you.